Hello, everyone. Sorry for that small delay. I was having trouble with my microphone. I think that you can all hear me now. If anyone can just chime in and confirm that you can hear me, I'd really appreciate it. We'll get started in just a couple of minutes. Okay, perfect. Thank you, Eric. Thank you, Matthew. Okay, you can hear me. Thanks very much. Appreciate it. My name's Stephen Reiter. I'm responsible for the options trading business at AvaTrade. This is our platform called Ava Options. You should be looking now at my screen where you can see a demo account for the Ava Options web trading platform. We're going to talk today about selling options and how to use the writing or the selling of options to enhance your returns. This is a very common strategy used by experienced options traders. We're going to keep today's webinar to about 40 minutes. I am watching the questions. Anybody posting questions, I'll do my best to answer them during the broadcast. We're going to get started in just 2 minutes as more people are signing in, and we have quite a few people who signed up for today's webinar, more than 500 people, which is terrific. So let's just give people another couple of minutes to log in. Let me start off also by saying that this is an informational only webinar. Nothing that I say in today's webinar should be understood as advice. We don't give advice. We open up the options market and the trading markets to any trader. We're not offering advice. You're responsible for your trading, and you must remember to always trade responsibly and within your risk appetite. Be wary of your usage of margin, and understand everything that you're doing. And if you don't understand your trading, if you don't understand things that I'm speaking about, stick with the demo accounts until you're comfortable. When you begin trading, start small. So again, this is informational. I'm being asked about interpretation into French. I don't think that the webinar offers live translations, but this webinar is being recorded. By tomorrow, it should be available online on the AvaTrade Ava Options YouTube channel. And there you'll be able to use YouTube to create automatic translations. Okay, so let's get started. I'm going to be using the web trading platform for today's presentation. I won't be using any other material. And you should be able to see my trading platform fairly cleanly. I hope you can. Let me give you a quick review of what you're seeing on the trading platform. Let's move this to full screen if I can. Don't know if I can. Yeah. Okay. So this is the Ava Options web trading platform. It's also called the Sentry Derivatives web trading platform. And it's designed to really help you understand options. It's a very visual interface that should really help you follow along. On the left side, like many other trading platforms, you've got a list of instruments that you can trade. Here I'm showing all instruments. We also can select favorites just by highlighting them in this orange star. And when I click on all, I can then choose to see my favorites right there, which are the ones that I've chosen. I can deselect some. I also can just go straight to the Forex majors, all the crosses, the FX minors we call them, equity indices, and emerging markets currencies, and we can trade any of these products. I'm going to just go back to all because you have a search box here, which makes it very easy to find whatever you're looking for. In the middle of the screen, we have the trading interface. So let's say we're interested in trading euro-dollar. I just click euro-dollar. You're seeing here history for the past. What have we got here? We've got about an hour of history. These are 1 minute bars as shown up here at the top. It says 1M for 1 minute. We can change the bars into 30-minute bars and then get more history. We can use the zoom in buttons to see more, or we can zoom out. And we also can scroll backwards to get a bit more history, not a lot, and then click the center to recenter. I'm going to go back to the 1 minute chart. So this is showing where we've been for the last minute. Sorry, these are 1 minute bars. So this is showing us where we've been. On the right side, you have a profit and loss diagram. And the whole point of the profit and loss diagram is to show us how much money we'll make. We stand to profit if the market moves higher, and how much money we stand to lose if the market moves lower, moves against us. And again, feel free to ask questions. I can choose to see the P&L in price terms, which is the same as the asset, in this case, Eurodollar. We can also see it in sterling terms if you have a sterling account, and this is a sterling account. We can see it in dollar terms because that's the term. We can see it in base, which is euros. So if I look at it in dollars, I can see that the market goes up. If I buy Eurodollar at 117.85 and it makes it to 117.95, then I'll make, let's see, where's 117.95, which is right there. Hold on. If you go from 117.85 and the market makes it up to 117.95, that's 10 pips, we'll make $100. You can see that right here on the right side. If the market drops 10 pips, we'll lose $100 because that's 10 pips, 0.001 times the quantity, which is 100,000. I can change my quantity up to 1 million in this interface, but of course you can also trade more. So 100,000, again, showing us a profit and loss. If I go short the market, then I'll profit when the market drops, and I will lose if the market moves higher. Why do we show it this way? Because we really want to focus on options trading. So instead of trading spot, I can click this icon or this button for spot, and we can choose an option strategy. Let's choose a call option. And here's a call option, and let's choose an expiration date. We can choose our expiration date with a slider. We can choose it with the date picker, or we can choose it with the standardized dates, standard tenors on the right, like a 1 month option. So I chose a 1 month option. What we're seeing now on the left side, we're seeing 1 month of history. In the center, we're seeing what's called the confidence range. This is framing the risk of the trade. It's showing us in the white dots at the top of this arc and the bottom of this arc, it's showing us plus and minus 2 standard deviations of movement for the next 1 month based on the implied volatility of the option. And on the right side, we have the profit and loss of this transaction. I can expand any of these windows, any of these sections. So here we can see we're going to buy this option. If we buy this option today, it's going to cost us $812. If I see it in pounds, because this is a sterling account, it's 587 pounds. I can also see the cost in euros. But let's stick with dollars. If I buy this option, it's going to cost me $811. That's the most that I can lose because I'm buying an option. I cannot lose more than what I pay for an option. If the market moves higher over the course of the life of this option over the next month, I stand to make unlimited potential profits. You can see that in the green, the P&L is unlimited. Whoops. I can change the strike of this option. It defaults to at the money, which in this case is showing a 118 call because spot's trading close to 118. But I also can just grab this call handler and I can change the strike. And as I change the strike up to 120, for example, you can see that the option is much cheaper. The 120 option only costs $200. The at the money option costs $900. No, we said 800 here. A 118 call costs $800 and an in the money option costs as much as you like. Let's say $2,000. But we can also sell options. And that's what we're going to focus on a bit today. If we sell options, we have unlimited loss potential if the market moves against us. But if we're right and the market doesn't move against us, then we stand to earn this, in this case, $300 premium. We're earning premium. We're like an insurance company by selling options. We're taking risk. And if we are pricing it correctly, if we are viewing the market correctly, then we stand to profit from being correct. And we're going to talk about that over the course of this webinar. I'm being asked if the platform is available for only the computer. We have platforms for Android and for iOS, for the Apple phones. You just go into your Google Play or Apple App Stores, look for Ava Options, and you'll find it. It has the same look and feel. It looks just like this web trading interface. We also have a Windows platform, which we're not going to be using today. It's more complicated. It focuses on numbers. It doesn't have this kind of a graphical interface. So there's selling a call. We also can do selling puts. If I sell a put, I'm taking the risk that the market goes lower and I start to lose money. But if I sell a put and the market does not move lower and it moves higher or stays around where it is, I stand to earn this premium, which I can keep if I'm right and the market doesn't move too far. We also have, I'm just going to put this back on buy. We also have the ability to place limit orders. On the right side of the screen, you see the word limit. It's the same thing in the mobile app. I click the word limit, and now I can choose to set a take profit or a stop loss, and I also can put in an entry limit. For example, this option right now, I could buy for 48 pips, 0.0048, which we said is $485. I can put in a limit order by clicking on the open limit arc, and I can say, I want to buy this option cheaper. I want to buy it for 43 pips, not for 48 pips. So I can leave a limit order saying I want to buy it at 43 pips, and then I can put in a take profit as well. With a take profit, I can decide that if the market moves higher and I start to make money, I want to take profit. I want to sell that option. I also can put in a stop loss. It says if the market drops, I don't want to lose more than a certain amount. If it drops to 20 pips, I want out. So I can just double click here. I'll put in 20 pips, 0.002. And I'm going to buy this option, let's say for 40 pips. I'm going to leave an order to buy it for 40, stop loss at 20, take profit at 200. And you can see we're going to enter the market if spot moves a bit higher. Right now, spot's trading at 117.85. It looks like it needs to get up to about 118.10 in order to be able to buy this option for 40 pips. So we're going to save money by buying it cheaper, but we only get to do that if the market moves higher. I'm going to have it stop loss at 20 pips so that the most I can lose is $200. You see that in the profit bubble here in red. If I'm buying it for $400 and I'm selling it for $200, my loss is $200. And on the profit side, if I buy it for $400 and I sell it for $2,000, then my profit is going to be $1,600. So we've got all the features of most retail trading platforms, much better, in fact, than most trading platforms because you can trade options and you can put in limit orders for options. The orange line, the red and green is showing us our P&L at expiration of the option. I'm just going to remove the stop loss for now. So the most we can lose, as I said, is about $400, what we paid for the option. The most we can make is unlimited, except that I've put in this take profit order. So the most I'm going to make is $1,600. The orange line is showing the profit and loss today as the market moves up and down. Because when you buy an option has a delta. If these concepts are new to you, please go back and look at the webinars that are available on the Ava Options YouTube channel. We have a webinar talking about delta. We have introduction to options webinars. There's lots of material there for you to learn. The orange line is showing us our profit and loss today. This option has a delta of about 32%. You see D equals minus 0.32 because this is a put. Puts have negative delta, which means that the profit, the value, the price of an option increases as spot decreases. And if spot moves higher, if the underlying asset moves higher, then the value of put option decreases. The orange line is showing us that today, for every pip that spot moves lower, I'm going to profit 0.3 pips. Or for every 10 pips the market moves lower, I'm going to profit 3 pips, 32% of the underlying move. That's why this orange line is smooth and curved, and it's driven by what's called the horizon line. So this orange line is showing us our P&L today, but we also can see it in the future over time, what happens over time. So we've got today, and I can move my horizon line to the future, It's a little hard to see with the limit orders because I'm using a small screen, so let me get rid of that. I got rid of the limit orders. Let's do this. Now you can see I can move my horizon line over time, and you can see how the performance of the option changes, how that orange line changes over time. At expiration, the delta is 0 or -1. Today, the delta is about minus 0.3. Okay, let me just have a quick look at your questions. Selling options, what is the margin? Our platform uses span margining, which means we look at the risk of your trade. Actually, we look at the risk of your portfolio in each underlying asset in order to calculate margin. I have an account here. Let's look at what if I click the information button, the I, you can see on the right, down at the bottom, the margin. This is an EU-based account. The margin for trading spot is 30 to 1, but when you trade options, you're getting leverage of 100 to 1, 1% margin. So options in the EU and also in Australia have a big leverage advantage over the underlying asset. ESMA and ASIC regulators have placed limits on retail leverage for trading the underlying assets. However, they have specifically excluded options trading. So if you're trading options in the EU or in Australia, we can give you 100 times leverage, which is the same as you'll get anywhere else. So leverage for options is 100 times. This account has no positions. If I look at the trade button and I click buy an option, buying options requires no margin. You pay cash, that's the most you can lose. No additional margin is required, no margin at all. However, if I sell the option, now you see that this trade requires about £500 of margin. 500 pounds of margin is based on what's called span margining. We said leverage is 100 to 1. So to come up with this margin, we stress test your portfolio. So we move spot up and down 1%, which equals 1% margin. We increase volatility and decrease volatility. We use 16 different scenarios to figure out what type of risk and shocks we can throw at your portfolio, and we see what margin is required to cover those scenarios. You can read more about it on the AvaTrade website. The complete formula is shown there in the trading conditions. So this trade will require, a 1-month option will require 500 pounds of margin. Let's compare that to just trading spot. If we trade spot instead, and to do that, I need some more space because I've got a small screen here. Let's put it to spot. So selling this option would require 500 pounds of margin. If I did a spot trade, I would need 2,800 pounds of margin because the margin for trading spot is 3% margin, or sorry, 3.3%. It's 30 times leverage. So even if we account for the fact that options get 100 times leverage instead of 30 times leverage, this option requires half as much margin again. And that's because this is an out-of-the-money option. An out-of-the-money option requires less margin than a spot trade. In fact, an at-the-money option requires less margin than a spot trade because the risk of an option at the money is about 50% of that of the risk of a spot trade, because the delta is 50%. So options require less margin, and because we give more leverage, they require less margin again. Now, that's market information. This is given, let me talk about this for a moment. Market information is showing us where implied volatility has been and where is it today. It's giving us the volatility surface. I've chosen here 1 month because we're looking at a 1-month option. The red line is showing where implied volatilities were a month ago. The green line is showing where implied volatilities were a week ago. And the blue line is showing where implied volatilities are today. So you can see that realized volatility actually has been much higher. This orange dot has been much higher than the current volatility. So volatilities are currently quite low. That could be for many reasons, but it could be because of equity volatility. It could be because of what was going on a month ago with the virus. It could be, there could be many reasons for it. If we go longer term, look at a 2-month option, you see a bit of a different picture. You can see that implied volatility is pretty much matching realized volatility. So we probably had a particularly volatile day in the last month that was skewing realized volatility higher. The bottom axis is showing us 10 delta puts, 25 delta puts. DN means delta neutral, which is effectively an at-the-money option, 25 delta calls and 10 delta calls. So out of the money options traded higher volatility than at-the-money options. And this is typical for Eurodollar. If you look at dollar yen, you might see a slightly different skew. Nope, same thing. In dollar yen, you can see that implied volatilities are significantly higher than realized volatilities. If I look at gold, you can see that implied volatilities are significantly higher than realized volatilities, because gold is considered a risk asset that is a hedge against stock market valuations, for example. So it's very common for gold volatility to trade higher than its realized volatility. On this platform, you can trade today options on any of the foreign exchange pairs, gold and silver, and soon we will have options on equity indices. Those are in development. So let's close this section here. Let's look at selling an option on Eurodollar. No, let's not do Eurodollar. Let's pick something that's got more value. One sec. Looks like I'm having an internet issue. One second. Okay. Let's look at, let's see, what does margin look like? What does realized volatility look like in dollar CAD? Click this I button. Dollar CAD looks very different. Let's go back to 1 month. So dollar CAD implied volatility is sharply skewed to the right, which is very interesting. And volatilities look like they're somewhat fairly priced, in that realized volatility and implied volatility today are around the same level. So let's say we're going to do an option on dollar CAD. I'm going to sell a call on dollar CAD. And you can see, let's say we're trading right now at close to 126, and I'm going to trade an option for a month. And let's say we're going to sell an option right up here along. If we do a little technical analysis, you see here that there seems to be a market hasn't gotten above 127. So let's say we sell a call at 127. We deem that as being a fairly safe option for a month. Strike at 127. I can earn 55 pips. You see 0.0055. I'm earning 55 pips for selling a 127 call for a month. That means my break even is going to be 127.55, right? Because I don't start to lose any money at expiration unless spot is higher than 127. I've got 55 pips of income that I've earned up front to cushion my blow if I start to lose money on the option itself. So my break even is going to be 55 pips higher than the strike. Make this a little bit, let's change this a little bit. You can see a little more. So here you can see on my cursor, the break even looks like it's at 127.55. You can see that also if I put in a limit order and I put in a stop loss, that break even right there, you can see is at about 127.55. So I'm selling an option. I'm going to earn 55 pips up front. I'm selling an option higher at a price that looks like it's bound by technical analysis. And if I'm right, I'm going to earn this 55 pips. But here's another strategy. Instead of selling just a call, we can also sell a put. Suppose I sell a put and I do the same thing. This is still a 1 month option, and I'll set the strike down by the lower bound of what we've seen. Let's say we put it right here at 124.50. We've only broken in the last month. We haven't broken out of the 124.50 except for maybe half a day when the low was 124, basically 124, a little bit below 124. So for that, I'm going to earn 41 pips. So if I earn 41 pips for this option, let's sell them both. So instead of selling just a put or just a call, I'm going to sell a strangle. A strangle is buying or selling both a call and a put at different strikes. If you don't know what the strategies are, click here to get a guide, click the strategy you're interested in, and it shows us that a strangle is buying, this is buying a strangle. This is selling a strangle. Selling a strangle, you're going to profit from a range-bound market. You're selling a call and selling a put at different strikes. I'm just going to click try it, and it populates a screen for us. So this is that same 1 month option, selling a call and selling a put. We said that we're going to sell the call strike at 127, the put strike at 124.50. I'm going to earn a total of almost 100 pips for selling both of these options. So my break even, it says 96 pips. My break evens, I have two break evens on the upside and the downside. My break even on the upside is going to be the high strike plus 96 pips. So my break even is going to be 127.96 on the upside. And on the downside, my break even is going to be 96 pips below 124.50, which is 123.54. All the way down here. So you can see the break evens are well outside of the range that we've seen in the past month. So it looks like a great trade. And why? Another reason it's a great trade, or why do traders like to sell strangles? Because you're selling two options at the end of the day. When you make it to expiration, you only have three possible outcomes. Either we're going to be above the high strike, below the low strike, or between the strikes. If we're between the strikes, you've earned all of your premium and you keep it. So you're going to earn your maximum profit, which was 96 pips, or in dollars or in pounds, you're going to earn your total profit. Where are we here? You're going to earn 552 pounds for this option. Yeah, 552 pounds. Because remember, the premium is expressed in Canadian dollars. It's dollar CAD. So let's look at it in CAD instead. Right, 962 Canadian dollars. So I'm going to earn 962 Canadian dollars if we finish between the strikes. If we finish above the high strike, we're going to start to lose money. Our break even 96 pips higher, and we can have unlimited loss potential. And on the downside, we start to lose money at 123.54, and then we can have unlimited downside as well. But what's really nice is that I can only lose on one of those options. Either we're going to be above the high strike or below the low strike. I'm not going to lose on both options as of the expiration date. And the orange line, look at the orange line. The orange line is showing you risk, how much the option price is going to move today. You can see that today it's not very sensitive to the move in the underlying market for small moves, because if the market moves down, you're going to start to lose money, a little bit more money on the put, but you're going to gain some on the call because the call is going to be worth less. You're moving away from the call. Same thing on the upside. So your net delta, the delta on the put is 40%, minus 40%. The delta on the call is about 50%. So the net delta on the trade is about 10%. So you don't have a lot of exposure today. Once the market starts to move a lot, then you can start to lose money. In order to profit from this trade, you need time to work in your favor. You've sold options. You need to give time a chance to work. Time is money. And you can see with the horizon line, over time, we're going to reach the expiration line, and we're going to get that full profitability. Today, if the market moves around, you're not going to make any money. Right? You need time to work in your favor. It's a 30-day option, 31-day option. About halfway through, your P&L looks like this, and then your theta starts to increase faster. And when you get to expiration, you're going to realize this beautiful P&L profile where you have a great profit range. Your range of profitability is all the way from 123.54 all the way up to 127.96. Now you can go and buy the option instead of selling it, but if you do that, you have just the opposite. You're buying two options and only one of them can finish in the money. So you would be taking the view that the option value is going to increase today because implied volatility increases or decreases. That's a different risk or a different trade. if you want to buy, if you think the market is going to suddenly become very volatile, if you think the option is too cheap, and you think that some event is going to drive an increase in volatility, you can buy a strangle and then sell it before expiration, or a straddle. But if you view the risk as appropriately priced or even rich, which is the normal case, options usually trade at a premium to the realized volatility or a premium to the perceived risk because it's a riskier trade. You're in the insurance business when you're selling options. Usually a lot of the smart money is selling options. So what's the margin on this trade? Let's click the sell button again. We get this panel on the right. The margin on this trade is only 356 pounds. The margin is less than it is for selling one of the options. It's actually less than selling the call, or it's less than selling the put, because the trades are both balanced. You can see your delta today in the orange line is very low. So actually the margin required today is quite low for this trade. The bid-ask spread is 109 pounds. If you like the trade, click execute. That trade is done. Now you'll see it in the panel below. And our open positions, we now have 2 positions that you can see. We've sold a put, we've sold a call. You've got a small P&L, that's the bid-ask spread, because everything is marked to market at all times, marked to the closing value of the option. You can see your total, the delta for each position, the vega, the theta, the dates. If you click the I button, you can get more detail about each option. Where was the market when we opened this trade? What was the cost in pounds? And this is all in sterling because it's a sterling account. And what's my unrealized P&L? If I click the risk manager, just expand this, you have this in the mobile app as well. The risk manager is showing us that we are long the Canadian dollar and short US dollars, right? Because our net delta was 10%. If I look at total delta by currency pair, we're short about 3,000 pounds worth of dollar CAD. We've got a very small position because the net delta was 10%. So 10% of $100,000 CAD, which is $10,000 CAD, which equates in the end to about 3,500 pounds worth of dollar CAD. If I go to total delta by currency, it breaks it down into CAD and US dollar. You can see what our net position is. Our net risk is very low, and you see it again down in the table, dollar CAD. We have 2 positions. Our net delta is short 4,800 CAD, or sorry, $4,800 CAD, and it's coming from the options delta. We have no cash position. So we've now taken a position. We believe that the market is going to be range bound, and we like that trade. Now, what does a typical options trader who likes this strategy do? Rather than putting all your eggs in one basket and just selling options on dollar CAD, a good options trader will often, or an experienced options trader will diversify his risk and sell options on other currency pairs. Think of yourself as an insurance company and you're writing an insurance policy for drivers. You don't want to insure one driver, you want to insure many drivers because there's always the chance that one of those drivers is going to have an accident. But if you have many drivers and you've priced the insurance correctly, you should have a profitable insurance business because you priced in the risk correctly. You know statistically that some of those drivers are going to have accidents. Now, in foreign exchange, it's a little bit different. We don't have as much predictability, but the market is telling us through the options trading market, through options implied volatilities, what the market expects volatility to be. Will it be right? No. It might be high, it might be low, it won't be exactly right, but all the information in the market, all the supply and demand is reflected in the implied volatility of that option. So you can take some confidence in the market, in the options pricing from the market, and you should diversify your risk, or you can diversify your risk by selling other currency pairs. So for example, let's do an option, and that was dollar CAD. Now let's do something like Aussie yen. Let's trade an option on Aussie yen. I'll look at our open positions here. Looks like I have a slow internet connection. Okay. Can someone confirm you can still hear me? Because I'm not seeing a lot of questions coming through. I guess if you didn't hear me, you would have told me. So let's look at selling a strangle on Aussie yen. And let's again do 1 month. Can someone hear me? Just pop in and give me the comment. Where is the comments? Yes, we can. Thank you very much. I appreciate that. Get a little nervous sometimes since it's one way. Okay, so here's a 1 month strangle on Aussie yen. I mentioned the 1 month straddle. Straddle is where the strikes are the same for the call and the put. And with a strangle, you can set 2 strikes. Strangle. And let's do the same thing. Let's look at a 1 month strangle. We're going to set the high strike right here at 85.25. Let's set the put strike right here. So we've got a 33 delta call and a 46 delta put. I click sell. I need another 243 pounds of margin for this trade in the size of 100,000. But the last trade was a dollar trade. It was a $100,000. Aussie is a lower price asset, 76. So let's do 150,000 of. Let's do 150,000 of this trade. You also have a calculator. You can type in 150,000 or in lots. Execute. That trade is done. And it's going to pop in here in a second. There it is. And if I look at the risk manager, you now see that we have four currencies of risk. We've got Aussie and CAD and dollar and yen. If we look at the total delta by currency pairs, it looks like I'm long some dollar yen, I'm short some dollar CAD. Total Vega is our sensitivity to volatility, the implied volatility. If implied volatility goes up, we're going to lose money today on these trades because the value of the option goes higher if implied volatility moves higher. This is showing us our Vega. If implied volatility moves up 1%, so from 6 to 7, or from 10 to 11, whatever it is, if all the implied volatilities move 1 vol higher, we will lose about 144 pounds on the dollar CAD trade and about 150. Let's move this, if we can see it in the table here. Our total Vega is about 150 pounds in dollar CAD and is 158 pounds in Aussie yen. So we're short volatility. So we're exposed to implied volatilities moving higher, which means we'll make money if implied volatilities move lower. But we're really in this for the expiration. We really aren't expecting big changes in volatility, but you need to be aware of it because it reflects, it has impact on your account value. And over time, we hope we're going to make money on both of these trades, but we've now diversified our risk. We're short Aussie yen, we're short dollar CAD, and we can do more of these and build up a nice portfolio of options. We can also diversify the trading dates, diversify our risk, sell options, be the insurance company, get paid for taking risk, and build up a conservative portfolio by diversifying our risk, making sure we're not taking on more risk than we can handle. Keep your margin utilization low. You saw that these trades don't require a lot of margin. However, if the market starts to move higher or lower in a significant way, the delta will increase and you will start to require more margin. Your account value will drop and you'll require more margin. So in this case, we're using less than 1% of our available margin. This is a 100,000 pound account and we've just done 2 trades. So let me just turn it over to questions. Being asked, can I do an example of a credit spread? In a credit spread is a trade where you buy one option and sell another option and earn income for that. It's another way of effectively selling options because the net risk on the trade is selling an option and earning premium. Now, unfortunately, in this interface, we don't have, we have spreads that we can show spreads on one expiration date, but I don't have a way to show spreads with 2 different expiration dates. For example, a call spread. And here's a call spread. If I sell a call spread, in Aussie yen, I can receive premium. This white button here in the center between the buy and the sell is also a button. I can see my premium in yen in this case. I can see it in Aussie. I should be able to see it in pounds, but for some reason I don't. So let's put it over here. Well, no, this is on the right side. The profit and loss diagram is showing you at expiration what your risk is going to be. But the real idea behind a credit spread is actually to use the same strikes. It's also a vertical spread. Let's choose a different currency pair. I'll do this relatively quickly. Let's choose euro dollar since we haven't done a trade yet in euro dollar. Let's look at euro dollar. I'm going to buy a call for 2 weeks. I'm going to buy a call for 2 weeks, and I'll set the strike at 118. That call cost me 473, well, that's a mistake, 47 pips. Or you can see here, it's 340 pounds. I'm going to buy that option. That's done. You can see that in here. There's our euro dollar trade at the top. Now I'm going to sell a longer option. I'm going to sell an option for a month. At the same strike of 118, sell. I'm going to earn 500 pounds for that. I click sell, execute. And now I'll show you one of the great features of this platform is that we can take multiple positions and see them in the trading screen. Let's close this. So now down in the bottom, we have 2 euro dollar options. Be there in a sec. We have 2 euro dollar options. We bought a call for December, for the 12th of April, and we've sold a call for the 28th of April. I'm going to choose them by clicking this checkbox right here. When I click the checkbox, this long call position shows up in the screen above. Taking its time. There we go. I don't know why it's doing this. Just going to close that so we have more space. So here's the call that we've bought, and let's see the call that we've sold as well. Now we're going to see both of these positions in the chart. And this is where you can see an example of a credit spread. We've bought a call which expires in about 14 days, right? That was 2 weeks. You can see it in the bottom. And we've sold a call that's longer. So if the market doesn't go anywhere, if we finish both options at the same level, we're going to earn that credit spread, right? I paid, where's my total cost? The first one I paid $400 for the first option, and I earned $800 on the second option. So I'm going to earn that net premium over time. It's showing us with bid-ask spread here. And over time, you can see that we're going to earn all of this income. It's a little bit complicated to understand. Not everyone's going to understand this, but you can see that we bought an option, we sold an option. If the market moves anywhere and then stays there, so that the first option expires, I earn profit on that first option, for example. The second option will give up that same intrinsic value, but I've earned net premium. It's a credit spread. And that's what this is showing us. And we can see over time how that would behave. Okay, so let's clear all that. So that's all the time we have for today's presentation. I'm being asked, can we do a strangle but limit the risk? So the risk is not unlimited. You can. You can leave a limit order on either of these options. For example, just do this last thing we're going to look at. Let's say we've got our dollar CAD option. We've got a put and a call, and you're concerned now on the put. You're concerned that the market's going to suddenly move a lot lower. You can put a stop loss on that option. Just click here, and I can put a stop loss to make sure that I don't lose more than a certain amount on that one trade. I do that. I click on close. So now I'm going to add a limit order at 3 points, which is going to basically protect us It's a little hard to see. It's going to give us protection on the downside. I click execute. That order has been placed, and you'll see in a moment in the open positions that there is now a limit order in blue on that Canadian dollar CAD put. It's in blue, it's pending. You see the arrow, it's attached to this dollar CAD put. You can put limit orders on every one of these trades if you like. Limit order doesn't cost you anything, and you can limit your downside if the market moves against you. But of course, when you reach a stop loss order, you're locking in your loss, which is what you're trying to achieve here. But it means if the market then returns back towards the mean, you've already locked in that loss. But you can leave limit orders with this platform beautifully. You can do it for spot trades. You can do it for options trades. For example, if I choose dollar Swiss and I trade spot, now we have symmetric risk, right? Because this is a spot trade. I can put in take profit and a stop loss and limit my risk on both sides. And I can do the same thing for options. That's all we've got time for today. This is being recorded. Tomorrow, you'll be able to return to the Ava Options YouTube channel and watch it again, and then you'll be able to get translations automatically. If you want to trade options and you don't have an options account, but you're already working with AvaTrade, you simply need to add an account. You need to add an Ava Options account, but you're already qualified and ready to start trading. If you've been approved, if you have an account in MT4 or MT5, you simply need to add an Ava Options account and you can trade options. You also need to make a deposit or transfer funds into your options account, but you can go ahead and trade. Again, remember, we've got excess leverage or extra leverage when you're trading options. You get 100-to-1 leverage instead of the ESMA or ASIC limits if you're in those countries. And you can trade, of course, spot on this platform. You can trade equity indices like the Dow Jones. Here's the Dow. It's the same product that you have in MT4 and MT5, the FTSE, the NASDAQ, US 100, we call it now. You can trade all of these things. Soon you'll be able to trade options on the S&P 500 and the NASDAQ. Thanks very much. Have a great day. Trade responsibly, trade safely. Remember, again, this wasn't advice. I just wanted to teach you about options and how many experienced traders trade. But trade responsibly, trade carefully within your risk limits. Thanks, everybody, and goodbye. Have a great day.